October 19th, 1987. Black Monday. In a single apocalyptic trading session, the Dow Jones lost 22.6% of its value. $500 billion vanished in 7 hours. The largest one-day percentage decline in market history. The terrifying part wasn't the scale, it was the speed. At 9:30 a.m., everything seemed normal. By 11:30 a.m., panic was setting in. By 2 p.m., the floor looked like a war zone. Papers were scattered everywhere. Grown men were shouting at the top of their lungs. At 2:47 p.m., the New York Stock Exchange came within minutes of shutting down. The specialists simply walked away from their posts. They couldn't handle the volume. The entire system nearly broke down from its own contradictions. But someone saw it coming. Someone tried to warn everyone. And that same person's warning system is flashing red again, pointing directly toward 2026. The man was Paul Tudor Jones, a brilliant hedge fund manager from Memphis, Tennessee, who most people had never heard of. At just 33 years old, he was already known on Wall Street as one of the most brilliant pattern readers of his generation. 3 weeks before Black Monday, he appeared on a PBS documentary called Trader. In that interview, he made a statement that would prove to be one of the most accurate predictions in financial history. He said the market exhibited the exact same pattern that preceded the 1929 crash. He said a major collapse was not just possible, it was inevitable. He said it would happen within months, maybe weeks. 21 days later, the market imploded. But Jones wasn't some lucky guesser making wild predictions for attention. He was a methodical analyst who had spent years studying market behavior with the same intensity that a scientist studies natural phenomena. He had discovered something that most people in finance either didn't know or didn't want to acknowledge. Markets follow patterns. Not loose, approximate patterns, but precise mathematical sequences that repeat across decades and centuries. Jones had developed the Elliott wave theory, combined with computer analysis of 150 years of market data. His system identified a mathematical sequence that appeared before every major crash since 1835. The pattern was so consistent that it worked regardless of economic conditions, technological changes, or geopolitical events. It seemed to tap into something fundamental about human psychology and crowd behavior. The sequence works in 3 phases. First comes the impulse phase, where markets rise in 5 waves over 8 to 12 months, marked by growing optimism. Second comes the corrective phase, where markets consolidate in 3 waves over 3 to 6 months, where doubt creeps in. Finally comes the terminal phase, where the pattern completes with a dramatic reversal within days or weeks. Jones wasn't just looking for general trends. He was tracking specific wave counts, measuring momentum changes, identifying precise mathematical relationships. When the pattern reached predetermined points, the probability of major moves became overwhelming. In September 1987, Jones's computers showed the market was deep into the terminal phase. The probability of major decline had reached over 90%. When the crash came, his fund gained 62%, while Wall Street lost everything. According to his proven framework, that same deadly sequence began again in late 2024. The 1987 crash happened because of program trading. Computerized systems executing thousands of trades per second based on mathematical formulas. These systems were supposed to be the solution to market volatility. They were designed to remove human emotion, to make markets more efficient and stable. Instead, they created a ticking time bomb. Here's how the mechanism worked on October 19th. As stock prices began to fall in the morning, the computer programs automatically triggered massive sell orders. Those sell orders drove prices down further, which triggered more computer selling, which drove prices down even more. It was a feedback loop that fed on itself, accelerating with every cycle until human intervention became impossible. The machines had taken control of the market. The terrifying reality was that nobody could shut it off. The computers were programmed to keep selling as long as certain mathematical conditions were met. And those conditions kept being met because the selling itself was creating the conditions. By the afternoon, traders were literally running around the floor trying to find someone, anyone, who could make the computers stop. But there was no central off switch. The system had become autonomous. The aftermath was equally revealing. It took the Dow Jones nearly 2 years to recover its pre-crash levels. Thousands of investors lost their life savings. Several major investment firms collapsed entirely. But the real damage was psychological. For the first time, people realized that the market could fall faster than they could react. That realization changed investor behavior permanently. Jones saw this coming because he understood something most investors ignored. Markets aren't rational systems driven by supply and demand. They're psychological systems driven by fear and greed, amplified by whatever technology happens to be available. In 1987, that technology was program trading. Today, it's something far more dangerous. Today, 70% of all trading volume is generated by computer algorithms that make 1987 systems look primitive. These systems execute millions of trades per second, moving billions based on microscopic price changes that occur in nanoseconds. In 1987, systems could execute 100 trades per minute. Today's high-frequency systems execute 100,000 trades per second. Modern algorithms analyze everything: news sentiment, social media trends, satellite data, weather patterns, even other algorithms' behavior. These systems don't just respond to market conditions. They actively create them. They've developed emergent behavior, where different strategies interact to create outcomes none were designed to produce. Modern algorithms amplify trends ruthlessly. They don't provide stability. They provide dangerous acceleration. But there's something else that makes today's structure exponentially more fragile than 1987. In 1987, most trading was still done by individual stock selection. If IBM crashed, it didn't necessarily drag down General Electric. Today, the vast majority of investing flows through index funds. When selling begins, it doesn't hit individual stocks. It hits everything simultaneously. Jones identified that crashes follow a specific mathematical structure. Steady gains create confidence. Rapid acceleration creates dangerous euphoria. Then comes the exhaustion point, where the pattern completes. The market doesn't just fall, it collapses. The acceleration phase began in late 2022 through 2024, driven by AI stocks and the Magnificent Seven. The exhaustion point typically occurs 13 to 18 months after acceleration begins. Even if the pattern stretches, 2026 represents the mathematical endpoint. Jones also analyzed debt patterns. In 1987, total debt to GDP was 250%. Today, it's over 350%. This debt creates the same feedback loop that destroyed markets in 1987, but 10 times larger. When asset prices begin to fall, leveraged investors are forced to sell to meet margin calls. Their selling drives prices down further, creating more margin calls, creating more forced selling. The system becomes self-destructive. The difference between 1987 and today is the speed at which this can happen. In 1987, it took 7 hours for the market to lose 22%. Today, with high-frequency trading and algorithmic systems, the same decline could happen in 7 minutes. Or 7 seconds. Jones understood something else that most people miss. He understood that crashes don't announce themselves with obvious warning signs. They announce themselves with subtle pattern deviations that only become visible in retrospect. The market doesn't ring a bell at the top. It whispers. Right now, that whisper is becoming audible. The same technical indicators that Jones used to predict 1987 are showing similar readings today. The same debt accumulation patterns are visible today. The same algorithmic amplification systems are in place today. The same psychological conditions of overconfidence and complacency are present today. There's one more element that makes 2026 particularly dangerous. In 1987, the crash was contained to the United States. Today's financial system is globally interconnected in ways that didn't exist in 1987. A crash that begins in New York will spread to London, Tokyo, Frankfurt, and every other financial center within hours. The contagion will be instant and universal. The Fed contained 1987's crash by cutting rates and providing liquidity. Within 48 hours, they had slashed rates and flooded the system with cash. The Fed's balance sheet was $300 billion, giving enormous room to expand. Today, rates have been near zero for over a decade. The Fed's balance sheet has exploded to $8 trillion. They've already used every tool available. What happens when the central bank has no ammunition left? In 1987, the Fed had 1,000 basis points of rate cuts available. Today, maybe 200. In 1987, the Fed's balance sheet was 3% of GDP. Today, it's 35%. This creates a policy trap where the system requires ever-increasing intervention, but capacity is approaching limits. Jones became successful not because he could predict the future, but because he could recognize when the present was unsustainable. He could see when mathematical patterns were completing. He could identify when systems were approaching breaking points. That breaking point is rapidly approaching again. The pattern is exactly 85% complete. If Jones's framework is correct, the final 15% unfolds by mid-2026. The mathematical window is rapidly closing. This time, the numbers are bigger, leverage is higher, interconnections are deeper. The trigger could be simple. A single rogue algorithm, detecting selling pressure and responding by selling more. That triggers other algorithms, stop losses, margin calls, more selling. Within minutes, the cascade becomes unstoppable. Today's crash won't be confined to stocks. The same algorithmic systems trade equities, bonds, commodities, currencies, derivatives. When one market breaks, they all break simultaneously. The contagion that took months in 1987 would spread in minutes today. The 1987 warning wasn't about that specific crash. It was about recognizing when systems become so unstable that collapse becomes inevitable. That recognition is flashing red again. The system is more unstable than 1987. The potential for failure is higher. The ability to contain damage is lower. Nobody talks about the 1987 warning, because acknowledging it means acknowledging we've learned nothing from history. We've recreated the same conditions that caused that crash, but amplified by orders of magnitude. We've built a system that's 10 times larger, infinitely more complex, and dependent on technologies we don't fully control. Paul Tudor Jones understood that patterns don't care about human intentions. Mathematical sequences don't care about policy interventions. Market cycles follow their own logic, and that logic is pointing toward 2026. What makes this particularly chilling is the mathematical precision of Jones's framework. Over the past 150 years, his pattern has appeared exactly 23 times in major markets worldwide. 23 times, it has led to catastrophic market disruptions. It has never failed. Not once. The pattern doesn't approximate future events. It predicts them with the reliability of a natural law. The pattern doesn't lie. If Jones was right in 1987, his proven framework suggests 2026 won't just bring another crash. It will bring the crash that completely redefines everything we thought we knew about financial systems and how little control we actually have over the dark forces we've unleashed.